Happy halfway through the year day to you, Stoffel.
Woohoo! Halfway.
Or as you pointed out in tomorrow's newsletter, almost halfway.
Yeah, almost. I think it's July 2nd. It's the 2nd or the 3rd. I can't remember which.
We're pretty close to it. Hey, we've made it through half a year here of 2026. So thank you to everyone that is joining us. Hello, Klaus. Hello, Tim. Hello, Robert, Ari, Francine, Mark, Constantine. Thank you guys so much for joining us today for another episode of Stocks from Scratch. Mr. Stoffel, today we are taking a look at AMD, a company that for a long time I thought was just kept around so that Intel wasn't a monopoly.
That's a pretty interesting stock chart right there, too.
We've seen this stock chart several times in the last couple of months, but we're going to be taking AMD through the Simplifier 7. So we're taking a look at all facets of the fundamentals of this business to figure out if we think that it's a buy, sell, or hold by the end of this series. Now, Stoffel, not all companies are easy to analyze. Their difficulty ranking does change from company to company. Retailers, restaurants are easy. Marketplaces, big techs, they're often medium, and the difficulty ranking just goes up from there. Where would you rank AMD?
I would rank it as like, I would go on the hard and then just nudge once to the left.
Okay.
Not to medium, but just like towards hard, but in between hard and medium.
Okay. Well, this stock is basically currently hitting an all-time high. So let us know in the chat if this is a stock that interests you. You know, yesterday I pulled up this company's stock chart and I did see that essentially if you bought this stock, I think it was 7 years ago, you have a 250 bagger.
250 bagger?
Yeah, it's just been massive.
So if you invested $4,000, let me just $4,000, that's $1 million right now.
Yep.
Wow.
Something like that. So let's check. So it's 572. This is the company. So when was it? Let's go 10 years. Yeah.
Yeah.
$6 a share. No, I think it was, 20.
Look at that. And woo.
2012. Yeah. You could have bought this for $1.90, under $2 a share in 2015. So left for dead. And it's been 200 and geez.
Yeah, that's about
closing
right.
in on a 300 bagger.
Yeah.
From those early prices. So good on you. And look at this. For most of this company's life, it was a good chunk of their life, it was underperformer. And then
it's been public for a long time.
Sure has. The CAGR since coming public is now, what's that? It's hard
14 and a half.
Yeah, 14 and a half. So it is a market beater. But with that, I think what most people understand about this company, it's a semiconductor maker. It has long been the second fiddle to Intel, but closing in on $1 trillion business. So kudos if you've had the patience to hold on to this company for a long time.
This the one that Lisa Su is the CEO?
Yes, it is.
Okay. Well,
fabulous management makes a difference.
She's going to enter this conversation quite a bit.
She sure is. Absolutely. So the mission statement here is to build great products that accelerate next generation compute experience of customers, partners, and the world. Your thoughts on the mission statement?
I mean, it's okay. I mean, when I look at these companies that are from the 60s and 50s, like I don't have high expectations for a simple, optionable, inspirational, proven mission statement.
Neither do I. All right. So what does this company do? Advanced Micro Devices designs high-performance processors of graphics chips that run data centers, PC, and home gaming consoles.
I wonder which one's the main one.
I can't imagine. Outsourcing the actual manufacturing to foundries. So it's a designer. It's not a manufacturer. I'm guessing TSMC, Taiwan Semi, I'm guessing that's their major outsourcing partners. Okay. Data centers compute. So server CPUs and AI's accelerators sold to cloud operators. Now the largest and fastest growing part of the business.
But wait, can I just say that's an important thing? It's not, because usually the fastest growing is the tiniest part of the company.
Correct.
It is the largest and fastest growing.
Not a bad thing. Client computing, Ryzen processors for laptops and desktops, including newer chips with built-in features, competing mainly with Intel. Yeah, that's the kind of core business that's been around for forever. Gaming and graphics, so Radeon graphics cards and the custom chips inside major gaming consoles, where AMD leads in console silicon. And then fabless model, they own the chip designs and the x86 rights, but no factories, concentrating its capital on engineering and leading edge foundry partners to build the actual silicon.
Yep.
Who are the customers? The buyers are companies that build computing products. So that would be the hyperscalers, the large hyperscalers.
You got your Metas, your Azures, your AWS, your Google Cloud.
PC and server makers, so equipment and design manufacturers, put their processors in the laptops. Console makers and embedded and industrial consumers. So they're a business-to-business company, not a business-to-consumer company.
Correct.
And if we dig in by segment, okay, we have data centers are half of the business, 16.6.
And what does it say down there? Does it say how much it's growing? Because we can always just click on fiscal to see how fast that's.
Yeah, we'll check on that. Client is 31%, gaming is 11%, and embedded is 10%. Geographically, 1/3 US, China, other regions. So 1/3 US, 2/3 not US. Yeah, if I click this button here, it should take me right to fiscal. And I like to take a look at the segments and KPIs in addition. And if we...
There we go. It's the second one. Yeah, there.
So
we just need to look at that first one right there to see what that data center revenue is doing.
Let me zoom in a little. And then I like to stack them. So data center in 2020.
58% revenue growth rate.
58. Yeah, this business is growing 58% per year. Not bad. Client is 15%.
That's not bad.
Gaming is 8%.
I think that's negative 8%.
Embedded is 83%.
Yeah.
Although lumpy, right? Yeah. And let's be honest, it's data centers that super matter right now. Okay, so there's the growth by segment. Now some quality questions. How predictable is revenue? Modest. Consumers buy on roughly annual refresh cycles, and revenue dips and recovers with the chip cycle rather than recurring like a subscription or locked in by a backlog. That makes sense to me, although no locked in backlog. Meta's plan to deploy up to 6 gigawatts of Instinct GPU is a forward intention, not a booked order. So no large backing orders guaranteeing future ever. Okay, so revenue is kind of predictable, not unpredictable.
Yeah.
Better than unpredictable for a company that makes processors.
They haven't done what we just saw Micron do, where they signed $100 million.
That was a game-changing move for Micron.
Yep.
Can it raise prices? AMD can push prices and mix when demand is strong, shown by expanding margins, but it sells against NVIDIA and Intel, where buyers comparison shop. So it can't.
It's worth pointing out that NVIDIA has really gotten into CPUs. That's what they've been touting in their recent conference calls. So it's not like, hey, NVIDIA's got GPUs, AMD doesn't need to worry about them. NVIDIA is very much moving in that direction as well.
Sure is. All right. So I would say, yeah, modest pricing power there. Is it recession proof? Sort of. In 2023, there was a downturn that was a shallow dip that recovered and fasted, but everything else is discretionary items. And only half of their revenue is now on this secular trend. So
half growing about 50%.
I'd agree with okay for recession proof. And then what's their competitive position? AMD is a strong number 2 in CPUs and data center GPUs, gaining share, but is still trailing peer medians. So a credible top tier player, not the leader. So they're behind Intel in processors, and they're behind NVIDIA in GPUs, but they're credible players in both.
Yeah. And again, this is the thing I always say. If you're selling water in the desert and Intel or NVIDIA has the Perrier, right? It's okay if you're selling tap water. You can still do pretty well.
Sure is. I'll just make a note of that. Great. So business overview, we'll dive into more. It's more by product segment, the growth, the geography, more details about each, but what to watch is a cool section here that we added. So data center momentum, watch where the data zebra keeps growing. I would say that that's correct. Through cycle margins.
What does that mean?
Good call AI. What happens to the cycles? What happens to margins through an entire cycle? Right now we're in an up cycle. What happens through the entire cycle? And then customer concentration creep. Any single large AI customer becomes a dominant revenue. I would say all of that's pretty darn good point out for AI. All right, let's voting time here. Let us know on a scale of 1 to 5. What do you guys think of AMD's business? Is this a 5 out of 5? Super excited to own it. 1 out of 5. Let's pass on it. Not interested in it at all. So let us know in the chat how you would rate this company. What do you think?
Feroldi, while they do that, I just want to point out that I would say it seems like about half of the folks joining us that responded own this company. I would put this at a 3.5, 4. You know, I love having the best player in a certain area. But again, this build out is unlike anything that I've ever seen. So it pays to be number 2. Shoot, it even pays to be number 3.
During a boom, all boats rise, right?
Yep.
So yeah,
I'd say 4 is what our average is.
I'd say that's pretty spot on here. Cool. All right, next analysis here. What phase of the business growth cycle is AMD in? So AI says it's in phase 3. The business is profitable and reinvesting all cash back into operations. Revenue is up 34%. It's making money and profits are increasing, and all cash is being reinvested. Looks like it was in phase 2 back when it was $2 a share, got to phase 3, dipped into phase 4 and back to phase 3.
I wonder what changed that.
Revenue is growing. Operating profits. The business is keeping more of what it earns, and operating profit grew from 3.6.
That's that down cycle right there that you see in 22
sure
and 23, where their fixed costs stay the same. And so when that revenue slows, it can really eat into profits.
And it didn't even slow that much.
No, it did.
Just by 900 million, but you can see what it did to profits. This was obviously a big reinvestment period for the business. So it does look like they're buying back stock, a couple of billion, but this is over the course of a year. And this is now a $900 billion company. So $2 billion compared to a $900 billion market cap. What the AI is saying here is that the company is repurchasing stock, but the share count is still rising. This is a critical thing. You can be, quote unquote, returning capital to shareholders via buybacks, but if the diluted share count's going up, we have decided to call you phase 3, not phase 4.
Because it makes sense. Like people don't buy phase 4 companies to be diluted.
Right. That's right. So over here, I'll just go with what the AI says here. The logic makes perfect sense to me that this is a company in the operating leverage phase. I mean, margins are still expanding and it's clearly reinvesting. So it is not primarily a capital return company. Just so you guys are aware, this is a really tricky line to draw because you can be buying back stock, you can be paying a dividend, but we don't push you over into the capital return line until you're paying a dividend, you are reducing the share count, or I think it's returning 25% of your operating profit to shareholders through those means. That's kind of the line in the sand that we've drawn. But again, if you disagree, you can choose whatever phase you want. But we're
I'll also throw in there, I think one of the big reasons was the acquisition of, is it Xilinx?
Oh, okay.
3 or 4 years ago was
probably here.
Yes. And that was a huge reason for that share count going up so much. I mean, if you pull up their shares outstanding, you'll see that it just balloons.
Right here.
Yep. There it is.
So it's the diluted share count rose over 5 years, almost entirely to the all-stock acquisition of Xilinx, but it's been roughly flat in the last 2 years as buybacks have offset compensation.
It's like a hybrid phase 3, phase 4.
Yep. Well, that's a fair point, right? That is good to see that dilution was up so much because of that. I'm sure that also messed up their profitability and everything like that. But
yeah,
again, it's on the line. It's like a 3.5 versus 0.4, but we have to make a call. I still think operating leverage is the right phase.
They don't have a dividend. Go with 3.
Great.
Now, here's the interesting. I mean, this is, hey, if you've got pushback in the comment section about the Moat, this is your moment. Let us know what you think of this.
AMD has a thin moat, Switching costs and patent lift the floor, but no source is dominant and returns only track peers. So moderate switching costs and an average patent position, but both sit above the weakest tier. No dominant source, no network effects, no cost edge, and no model conflict shields the franchise.
Wait, real quick, that model conflict, that's huge because what NVIDIA has is CUDA. And so they have, and I do know that AMD has, I can't remember the name of it, their own software language, but the adoption is nowhere near what CUDA is.
CUDA was a fabulous investment by NVIDIA. Just fabulous. And the return on invested capital is 7% and a 19% cash margin. So the return on invested capital, perhaps not the best metric to look at here, but the cash margin of 19% is great in absolute terms, but trails NVIDIA. Like
I mean, NVIDIA is at like what, 50%?
Yeah.
And Micron's up there too. It just shows you they do not have the pricing power that those other players have.
Yep. All right. Now, it does say the Moat is stable. All 5 sources are holding, and the recent jump in returns is a cyclical rebound, not structural strengthening. All 5 protection sources are rising. The returns cover a bounce through the 2023 trough, not through cycle gains, and clients and server share gains shown as revenue, but not a wider structural barrier. Let's dig into the...
Just real quick before we dive in, we've got some disagreements. One says on a scale of 1 to 5, this deserves a 500. And Brandon says he doesn't think this is right. Oh, that's right. Rock'em. That's their CUDA proxy. Brandon says the EPYC chips, server chips are so good that they create massive switching costs. All right. So that's worth.
Well, let's read into this.
Yeah.
Leaving carriers and real validation, firmware, and software tuning work, and Instinct needs ROCm investment, but x86 compatibility lets customers move between Intel and AMD. So switching a data center deployment means revalidating firmware and returning software, and adapting Instinct requires investments in the ROCm stack. The x86 software compatibility is what lets customers move between Intel and AMD, keeping the friction short of destruction, structural lock-in, and no retention metrics, no churn, no retention figures are disclosed.
Yeah, it is hard if we don't have those metrics.
Yeah. Although deals like Meta's could deepen it. So it's not saying no moat. It's just saying switching costs are not a mile wide. They're moderate.
They're narrow.
Yep. And the same thing, I guess, on the patent side. So the main intangible is the patents. The x86 cross-license held only by Intel and AMD protects CPU revenue, but no single patent is material, and the brands carry no clear price premium. Will people pay more for AMD? That's what this one means.
Yeah,
Are
so
people paying more for AMD versus a competitor?
So I always love, if you can take a disagreement and boil it down to the point of real disagreement. And this is what it would be. So Brandon's saying the EPYC server chips are so good they create massive switching costs. Here, if you click on that card and flip it over,
this one,
it talks about it. And what it says is that EPYC carries recognition, but no clear pricing premium. So the good thing is I think of Stock Simplifier as my junior analyst, that instead of having to pay him or her $100,000 a year, I can, get Stock Simplifier to do it for pennies. That's the question I would go and answer. The EPYC pricing premium, is it there? Because if Brandon's right, it'll show up there.
Yep. There are share gains. So let's go into that. So our switching costs, there's real friction, but not lock-in. Mm-hmm. And the compatibility with the x86 software is the real reason why it's not giving way wider. Do customers pay more for the brand? I'd say no. I mean, people know the brand. So this is important. Let's dive into this. Just because you know the name, I think everyone knows the name AMD. Mm-hmm. Do you recognize it? Alex Hormozy had a great video about this. It's when you see the brand, do you react to it and change your behavior because of it? Are people knowing about something and react to it different? I know the name Delta. Mm-hmm. Am I going to change my flying behavior because of the name Delta? Am I going to pay more to fly in a Delta plane versus a Southwest plane? So knowing a brand, important. Changing consumer behavior is the thing that really drives
that's the needle mover.
Returns and brand and pattern. So that's what we're seeing. What to watch? ROCm versus CUDA. Watch whether
There it
AMD's
is.
software ecosystem closes the gap with CUDA. A sustained development could begin building a network-like advantage and lift the Moat direction while continued CUDA dominance keeps that source absence. So
that's huge.
Well, let's let people vote. What do you guys think?
So they're going to give us two numbers.
Yep, two numbers. So the first number is what number would you give the current size of the Moat? The second number is what direction do you think the Moat is going? So AI says 2 and 3. If you know this company better than we do, let us know in the chat what you would put for this.
So while people are doing that, I'll tell you that I think of this as a 3 and a 4 personally.
Okay.
I've got one person that agrees, but we've got someone else who says a 3 and a 2. So eroding a little bit. 3 and a 5, 2 and a 2, 3 and a 3. We're kind of all over the place. What it seems like in every single one, except for one, is that it is stable to expanding and thin to narrow size, stable to growing for the direction.
I think I'm with the crowd and you here. I'm kind of partial to 3 and 4.
Mm-hmm.
I like the investment in the ROCm. But I think they have a moat versus smaller people, smaller rivals. But do they have they're not the top dog in either of their core markets, right?
Here's the big thing. This is how I think about it. When supply eventually catches up to demand, and look at it, it could be 20 years until it happens. I don't think it'll be 20 years, but when that happens, I don't see AMD, depending on the valuation, as being one that's going to just survive unscathed. I mean, everyone will suffer, but I worry about that.
Fair enough. All right. Well, again, those are our scores. Feel free to disagree with us. Growth potential. I think the bulls are going to like this. 5 out of 5, very high. Analysts expect revenue to grow 44% next year to about 50 billion. And that's on 47 analysts.
Wait, I'll even give you one further because I pulled it up on Fiscal. So 40 some odd next year. The year after that, 55.
That's only 10% growth.
No. 44% growth.
Oh,
this year.
Yeah.
55% growth expected the following year.
Yeah, and look at the trends.
Yeah.
All the trends are way up. Yeah.
I mean, if you stack 44%,
that's crazy. That's crazy. And if we go to just the overview numbers, so revenue 48% over the next 2 years, earnings per share 40%. All right, so that's the backdrop. Why? Well, no surprise. Data centers forward beat the past the 44% revenue growth trails where they were. Broad-based growth. Clients rose 22%. So the growth is spread. Look at the historic growth, double digits all around. The earnings growth, which we now know here was due to the Xilinx thing. Is the industry growing?
No
for
doubt.
Sure. The industry is definitely growing. Can the company launch new products that drive growth? Likely. AMD has more than one new vector beyond its core. AI networking chips embedded in automotive via Xilinx and rack scale systems with the ZT acquisition. So, all right. I think we know how people are going to vote, but let us know 1 to 5. What do you guys think of this company's growth potential?
I want to pull up. So this is interesting because what Michael brings up, he's watching on YouTube, is that AMD is benefiting from the same type of thing that you talked about at the top of this program, which is keep AMD around so that Intel doesn't have dominance on CPUs. And Michael's saying there's the same type of thing happening here. It's not government protection, though. It's hyperscalers need AMD so NVIDIA can't have 95% free cash flow margins. Sure. That's totally fair. But again, as long as supply and demand are out of whack, because once they do align, then NVIDIA is not going to have those margins either.
There you go. Yeah. So, oh, wow. This is not a unanimous consensus like I thought it was going to
No,
be.
there's a lot more fours and fives, but a lot more fours. I figured it would be all fives.
So my guess is, this is a guess, and let me know if I'm reading minds correctly. My guess is people are saying, yeah, the growth in the next 2 or 3 years is going to be fantastic. But what about beyond that?
Right. Sure.
All right. People,
it's high. It's no matter what, it's above average to high.
It's not average. It's above average. I'm going to go really high. I don't know how.
Hey, look, if
we went a little conservative on the
layer
Moat.
50% growth on top of a prior year of 40% growth, you
bananas is the key point. All right, management time. 5 out of 5 greatness.
5. We don't even need to vote on it. Lisa Su is amazing.
Long tenured, heavily invested leadership with an unbroken record of beating revenue and strong capital allocation history, offset mainly by 5-year share dilution. But we know the dilution is acquisition.
Silence.
A proven aligned CEO, Dr. Lisa Su, has led AMD for 11 years, holds almost $1 billion in stock. So she got in at like the $2 level. And drove the turnaround and the Xilinx and ZT acquisitions. Management has beat revenue expectations in all 8 of the last quarters, and free cash flow margin recovered. The dilution is up a bank, but that's held flat lately. So this is the co-founder. He left in 20 years ago. This is Dr. Lisa Su, president and CEO, chairs the board. Yeah, she's the real deal.
Tell you what, if you want to see something really impressive, you should look at what AMD's gross margins have done since 2016.
I will, but let's get management. So do employees like working here? Yes, 4.4 out of 5.
That's pretty good.
Do they beat expectations? Yes, they consistently exceed expectations. Are the management shareholder friendly? Sort of. Stock pay ran about 5% of revenue and the share count rose, but it's been flat recently. And our free cash flow margin strong. Yes, we know that. So in the deep analysis here, we go deeper. We just built this tool here.
Hey, I see the revenue now. That's awesome.
We actually include revenue and earnings per share. So you can track those. And I value revenue a heck of a lot more than I value earnings per share. So beats all around on it. So 1 to 5, what do you guys think of Dr. Lisa Su? Poor, decent, great. AI says 5. Do we have any dissenters? Now, while we're waiting for that, you said go to the margins?
Yeah, just look at the gross margins from like 2016 to today. I mean, this was
a company stuck in the 20s, and now the gross margin is 50.
Yeah.
NVIDIA's in the 70s or 80s or something.
5s across the board, Brian.
Unanimous. People love Dr. Lisa Su, and how could you not, given the returns, given the incredible execution. Again, I view like 10 years ago, AMD was kind of a joke. It was like a second also ran business.
It's a commodity business.
Yes.
You know?
Fabulous. Obviously a fabulous leader. Execution risk. AI says 3 out of 5. The one elevated risk is external. Heavy reliance on Taiwan Semi and Taiwan, large China exposure and export controls set against a strong balance sheet and diversified customer base. So foundry dependence with Taiwan Semi and Taiwan.
Everybody has that though. I mean, you got to remember.
Yeah, but it's still a risk. It's still a risk.
Sure.
It's definitely a risk worth considering. The U.S.-China export rules that's the biggest outside force risk.
Yeah.
No customer is 10% of revenue. The balance sheet is near net cash with 20x interest coverage. Disruption risk is only moderate. No single threat. So revenues are highly diversified.
Which is something that a lot of other chip makers cannot say.
Absolutely not. That is impressive for essentially a number 2 player. Is disruption a threat? Some risk. ARM-based architectures and hyperscalers building in-house chips could chip away at demand, but both are early, and AMD itself is integrated an AI compute provider. They're building the chips. Okay, so they're more on the disruptor side than the disrupted. How much is outside of the control? Taiwan Semi and Taiwan, 2/3 of their revenue is abroad. Tariffs are a problem. Export controls. Geopolitical is a non-zero risk here. How healthy are the financials? They are fantastic. All right, let us know. What do you think about the risk level of AMD? The business, not the valuation. That comes next. Just the business.
Remind us. So like a 1 is super risky.
Yep.
And a 5 is super safe.
Yeah. 5 is always good. 5 is always better. 1 is always worse. Right.
Yeah.
I'm curious if we dig into the details there. The risk assessment was moderate. Revenue we saw was good. Disruption was good. What to watch? Export control scope. The foundry concentration. Watch if they diversify. Meaningful diversification would reduce outside forces risk. That is for certain. And that is definitely in their control. Customer concentration and the in-house silicon.
I would say our average is between a 3 and a 4. I would put mine at a 3 personally. I mean, to me, the biggest risk is signs of a slowdown in 2 or 3 months. Meta and Amazon and Microsoft are going to start forecasting their capital expenditures budget for 2027, right? Maybe in like 4 or 5 months. And when they do that, if they say that it's going to be flat, those stocks are probably going to shoot up. But the stocks that supply Amazon, Microsoft, and so on and so forth, it's going to be interesting to see what happens there. So that's why it's a 3 for me, because if it even like just stays flat, the market might have a not great reaction to that.
For sure. Valuation time. Okay. Now remember, we said that this was a phase 3 company. So, and we do know that there was a change to the company's profits. So this says AMD looks expensive. The PE is 188, above historically, putting it in the yellow, outweighed by a softer price to free cash flow of 167. So the PE ratio is way above its own history. Free cash flow is about double its average and a steep, broad market premium. So yeah, look at the bands here for red, yellow, green, right? This is a company that has traded at a very high premium, at least on a price to earnings basis over the last couple of years, but you have to ballpark that against the growth. Yep. So price to free cash flow is very high right now.
What about operating cash flow?
Same story.
Yeah.
Price to operating cash flow. Shareholder yield. So this one higher is better. The yield got up to about 3% before. Price to book is high. Price to sales is 24. Price to gross profit also really high. These are trailing numbers. Let's take a look at some forward numbers. Those will be those might tell a different story. So if we go to ratios and then we go to forward valuation, let's go forward price to earnings first. Well, there's an ugly thing right there that's throwing it off. So let's erase that. That was,
and then what do we see?
17. All right. So here's forward price to earnings over the last 10 years.
Basically at an all-time high.
Average is about 35, currently 62. This is price
growth rate's probably double what it traditionally is too. So
got to as low as 18 times forward earnings. That's PE. If we look at price to free cash flow, I'd imagine a similar story. Price to free cash flow forward. If we put on some lines here, the average is about 39, currently 98. And remember, this is next year's free cash flow, so it does factor in that. And if we do a reverse DCF, is this an appropriate company to do a reverse DCF on?
I think as long as you have to optimize the margins. And actually, I think that right where they are, about 20%, that's a fair, optimistic margin to shoot for as an average over 10 years.
All right. So
I would bump that up to maybe 3%. And then I think we get a relatively stable number. Like, yeah, it needs to be mid-30s growth for a decade.
Mid-30s growth for a decade in revenue for a decade. So this is a company that's doing, again, what was it right now?
It's about
and this is free cash flow, $7 billion in free cash flow right now. For this investment to pay off at this price, reverse DCF says you got to get 100 $325 billion. So they have to 20x free cash flow. the thing doesn't even go that high.
No, I mean, like what it comes down to is, think about it. So if it needs to grow, let's just say it needs to grow 34% revenue per year and maintain those margins. That's key, Brian.
Yeah.
Because maintaining the margins is not an assumption you should make without introducing some doubt there. Yep. But if we give them that, they are expected to grow faster than that over the next 2 years.
2 years.
And then pretty much hit that level. So the big question is, what's going to happen in years 4 through 10? And that, like, we always come back to the same question on these, which is no one's doubting the growth over the next 48 months, right? Or 36 months. It's about what happens after that.
Yep. Now, if you double the free cash flow margin, right? What happens to the assumption?
If you double the free cash flow margin to almost
So this is assuming free cash flow margin stays consistent at 20%. If we doubled that assumption.
If we double that assumption, then what I'm getting is that growth needs to be, I'm figuring it out right now, it needs to be about 22% per year.
All right. So if you believe this company's free cash flow margin has a lot of upside potential and can double to 40%, then the growth rate drops to 22%. Effectively, does it become a true free cash flow machine? But even at this level, right? You're talking about a company that has to do, even at that extreme level, 300 billion in free cash flow. In revenue to generate that free cash flow. All right. Given what you know about the reverse DCF and the multiple analysis, what do you think of the valuation of AMD today? 1, super expensive; 5, super cheap, or somewhere in the middle? I'd love to know.
I'll tell you. Jen's is a 1 to 2. Tim's a 1. We got a 2. I'm a 2.
2?
Yep. Just because I could see a world where those predictions, so the prediction was what, like 55 and 45 over the next 2 years. I could see a world where if we do this 2 years from now, we'll see that it was actually like 62 and 50. So that lowers what they need to get the rest of those years. So that's the only reason it's not a 1. This
is a company with a fabulous execution track record since Lisa Su took over.
Yep.
So again, the momentum crowd definitely has this stock in their radar right now, and the momentum crowd does not care about reverse DCFs at all. This is the fundamental crowd definitely does. So I'll go 2 out of there. So to review, this is a 4 out of 5 business in the operating leverage phase. It's got a 3 current moat. There was disagreement about that. A 4 moat direction. There was disagreement about that. High growth rate, outstanding management team, moderate overall risk, with the biggest risk being outside factors, which could be diluted over time if they diversify their building, and a expensive stock. So that to me screams a stock that, hey, great score, terrible price. That's a good watch list candidate in my book. So I'm going to put that company on my watch list. Side note, we've been using Stock Simplifier to do all of this analysis. We have 2 versions of Stock Simplifier that you can sign up for. We have a standard plan, which costs about $16 a month. It's billed at $199 annually. We also have a pro plan that's $33 a month. The pro plan includes that reverse discounted cash flow calculator, as well as the deep dives. So if you want just the shallow dives, as we call them, we have the standard plan. The pro probably goes a little deeper. You can try Stock Simplifier with a 7-day free trial. So if you just want to kick the tires and get it going, we do offer a 7-day free trial on the standard plan. And if you use the link that Stoffel is going to share in the chats, it'll get 10% off the standard price. So it'll be under $15 a month to give Stock Simplifier a try. And again, you start your 7-day free trial, $0 today. If you decide to stick with it after the 7 days, it's just $15 a month to do so. So we hope that you find that to be a very compelling price, as we think it is. In addition, everybody that signs up for a premium plan to Stock Simplifier is going to be invited to a private webinar that we are doing tomorrow, where Stoffel is going to be revealing his top stock for July of 2026, a stock that he is buying. This is going to be taking place July 1st at noon. We invite all premium members of Stock Simplifier to it. He's going to walk you through his stock, exactly how much he's buying, how he thinks about position sizing, and all that kind of stuff. So if you become a Stock Simplifier premium member, you will get invited to that.
Yep. I'll give you just two teases. Tease number one, it's a company relatively in the same general area as AMD, which is a big deal, Brian, because this is an area that I have typically shied away from for a really long time because it's a commodity-ish type business. And number two, we cannot promise that this will always happen. In fact, I shouldn't even be saying this, but last month in our special, I highlighted my number one, and it was Axon. And I don't know if you've checked, but over the last week plus, it's up almost 40%. No promises that that'll happen next time, but that the people who visited were able to find out why I was so bullish on Axon.
You've been bullish on that company for a long time.
Yeah,
so
it's been almost 10 years.
You being super bullish on a company you followed and owned for a long time is usually a good signal in my mind. Yeah, AMD. Well, thank you guys so much for joining us today. We hope that you found this to be useful. If you're interested in Stock Simplifier, use the link that Stoffel shared in the chat or below on whatever platform you are watching this on. We will be back next week to do another stock from scratch using the Stock Simplifier 7 framework. So hope to see you guys, Jen. Thank you so much for joining us.
Hey, and everyone who's in the States, happy 4th of July.
We'll happy 4th of July. 250. We made it, America. All right.
Bye, everyone.
Bye, everyone.